Welcome to another episode of Quest for Twice. Today is August the 8th. The earnings season has peaked, and now the major companies in my portfolio have mostly reported their earnings. So in this episode, I'm going to review a few. Energy Transfer reported a fairly boring earning update. So if we look at the major financial and valuation metrics, there has been very little change from the update after first quarter. So the key metric is EV over EBITDA about 6.6 at the current price of $12.90 per unit. And the price over DCF it will be about 5.5 with a dividend yield about 9.7%. So I consider Energy Transfer as undervalued. Equitran also reported the earning. In terms of growth opportunities, its Ohio Valley Connector expansion project was approved by FERC. Its water pipeline and storage project is on track. In the second quarter, its segment ops income was $0.5 million with $7 million of EBITDA. Although that's less than first quarter. Finally, the Mountain Valley pipeline has been approved with construction ongoing and expected in-service date at the end of this year. So next year, with the MVP project in service, the expected EBITDA will be about $1.34 billion, with a similar amount of deferred revenue at $0.33 billion. We set aside $0.28 billion for maintenance capital and $0.44 billion as an interest payment. The DCF will be about $0.95 billion next year. That's more than enough to cover the dividend as well as capex combined. So with the enhanced EBITDA next year, the debt to EBITDA plus deferred revenue will drop to about 4.1. That's not too much leveraged. So this table compares Kinder Morgan against Energy Transfer against the Equitrans. So Kinder Morgan EV over EBITDA is 9.0 comparing to 6.6 and 6.8 for the other two companies. So the other two companies are lower valued compared to Kinder Morgan. As I mentioned, next year the Kinder Morgan is about 4.8 billion DCF compared to 7.2 for Energy Transfer and almost $1 billion for Equitrans. So the price over DCF is about 8.1 for Kinder Morgan and 5.6 for Energy Transfer and 4.6 for Equitrans. The reason Equitrans has a lower price to DCF ratio is because Equitrans is more heavily leveraged. So it depends on the valuation metric one looks at. Equitrans may present better value than Energy Transfer. Regardless, both Energy Transfer and Equitrans are better investment than Kinder Morgan at this stock price. ATKR also reported the earning updates. For its electrical segment, its revenue was over $600 million, actually went up compared to first quarter and the second quarter of this fiscal year. It declined from 1 year ago in terms of both revenue and margin. That's because of last year was abnormal in terms of a very tight market and a very high premium price the buyers paid to ATKR. Now the price is normalizing. Its mechanical segment had a revenue about $240 million. It's about the same as second quarter and went up from first quarter and also went down from 1 year ago. Its margin was 10.1% compared to 19% 1 year ago. The big margin drop was actually because of a accounting artifact due to the solar credit in the Inflation Reduction Act passed the end of last year. Without it, its EBITDA margin would have been comparable to 1 year ago. So in a normalizing environment, the good news is its volume actually went up by about 2%. And also the fairly large price decline of 19% was offset partially by acquisitions. For example, the electrical sales from M&A 30% offset the price decline. And for mechanical segment, the volume growth offset the price decline by 50%. Its full year EBITDA guidance was unchanged around $1.03 billion. The management guided the fourth quarter EBITDA around $220 million. So we can say for sure that the long-term quarterly EBITDA will be over $200 million because of the acquisitions and the price margin improvement. As a result, its full year EPS is $19.1 per share. And year to date, cash from operations was about $564 million with steady working capital. That's more than enough to cover the capex and mergers and acquisitions. Even if we add buyback about $460 million in this year, the cash drain was not that much. And because ATKR has a lot of working capital that will be released when the price normalizes. So ATKR has a lot of firepower for future buybacks. Looking at the valuation, with $150 per share, its enterprise value is about 6.5 billion, and EV over EBITDA of 8.1, using $800 million sustainable EBITDA. That probably is an underestimate because ATKR is having its plant manufacturing torque tube online in just the recent quarter, and the HDPE investment will start to produce cash and EBITDA next year. And there are multiple secular trends, including charging network, broadband, solar power data center, and warehouses will drive the demand for ATKR's products for years to come. One benchmark I use is Hubble, which has a EV over EBITDA ratio of 16.8. So ATKR is significantly undervalued compared to Hubble. And if we look at the PE ratio using the guided $19 per share, then the PE is only 7.9. So my original investment case is still valid. Now I'm going to switch gear to cover some of the major tech companies. So Google had a solid second quarter. Its cloud revenue grew by about 28% from 1 year ago. Its services revenue grew 5% year on year. That's an improvement from stagnant growth 1 quarter ago. That reflects the general strength in the economy. And also, its operation margin rebounded due to the cost reduction activities Google took at the end of last year and the first quarter. So now its ops margin is stabilizing around 35%. However, its stock price had a significant run-up in this year. Now its enterprise value over ops income has reverted to mean, comparing to its historical range since 2013. So I would say it's no longer undervalued at this point. Meta Platforms also had a similar story in terms of business. Its stock price declined 65% last year, but went up 150% year to date. Its fourth quarter sales went down 4%, and first quarter improved up by 3% and beat its guidance. And the second quarter beat the guidance again, with sales increase 11% year-on-year compared to 7.5% guidance. Its operation margin was 29%, same as 1 year ago. That's despite the two one-time charges from legal expense as well as restructuring. That's an 8% margin hit. So its clean operation margin would be in the high 30s without those special charges. Its second quarter R&D expense went up 8% year-on-year. That's a deceleration, with half of that driven by charges. So Meta Platforms has been stabilizing its advertisement revenue and become leaner and more efficient in terms of operation margin. Of course, it's still spending heavily on Metaverse, with a 3.7 operation loss in the most recent quarter. So if we look at the valuations, EV over EBIT now is 28 compared to 8.5 at the end of 2022. Now that's not any major bargain at this point. Similarly, its cash flow yield is 6.6 at the current stock price, despite investment in R&D and Metaverse, which is not bad, but it's no longer a screaming purchase in my perspective. Of course, I missed out because of my boneheaded move at the end of last year to capture my capital loss. So that will definitely go into my year-end lessons. Now let's look at Amazon. In the most recent quarter, its sales increased 11% from 1 year ago. That's an acceleration from previous 5 quarters if we ignore the third quarter last year because of the Prime Day timing impact in last year. In the third quarter, the management gave a guidance of a 9 to 13% growth outlook, which is also very strong. AWS continued to decelerate, coming in at 12% growth year-on-year. However, all the other segments are improving or stabilizing. According to management, AWS is also bottoming out and with improved growth in the coming quarters. Amazon reported ops margin about 5.7% compared to 2.7% 1 year ago. So that's a significant increase. That margin improvement was driven by COGS margin as well as fulfillment cost improvement. As we can see from the top right, its COGS margin declined to just about 50% in the most recent quarter, compared to over 60% 2 years ago. Its fulfillment cost as a percentage of revenue also reached 16%. We can see that management is working its way through the overcapacity in labor, fulfillment, and distribution centers the management highlighted 1 year ago. Its technology and marketing cost went up 21%. That's a deceleration from over 30% in the previous quarters. So because of all those improvements, its operation margin more than doubled from 1 year ago. Of course, one of the most important segment for Amazon is its AWS segment. So its ops margin there was 24%, no change from previous quarter, and still less than a norm of 30%. The management stated that its segment business is decelerating but has stabilized. So we should expect to see margin and revenue growth to improve in the coming quarters. So the valuation metric, I use EV over gross income. That's 6.3 at $140 per share. That's among the lowest since 2015, except 4.1 at the end of last year. So obviously, last year was a good opportunity to buy, but having missed that, right now it's reasonably priced. One can even argue there is still a small discount in its valuation level. This concludes the latest episode of Quest for Twice. Until next time, happy investing.